to this investors briefing covering the first half of the year of the group. And we'll start at looking at the environment under which we have operated for the last 6 months, or the reporting period, and maybe try to deduce how then performance should be impacted, and then we'll try to reconcile any differences between what the macroeconomic environment suggests and the reality. So if we could, Alex goes to the macroeconomic environment and trades, indicators and trades, we see that in the first 6 months, we see inflation, particularly within the East African countries, have been fairly stable, save for Kenya. And for Kenya, we know the inflation driver has been more of food inflation, and that's why after the food situation is addressed, the inflation indicators is almost tying with the rest of the East African countries. If you look at this critically, inflation rates of around 6.5 are what one would expect within the region. When we look at the foreign exchange, we see a fairly small fluctuation within a very small margin of between 102 and 104. So inflation, again, one would not say it's a major challenge to performance or economic performance. And lastly, when you look at within the underlying foreign reserves, that would really have implication on direction of exchange rate, we see that the crude oil prices remains fairly stable, and consequently we would expect if that is sustained, then the exchange rate will remain fairly within a very small range of fluctuation. And that is very well then founded when you look at the import cover at 5.2. We feel that exchange rate is unlikely to be a major challenge to the banking, to the economy. And then the last market force, the interest rates and driver, we see very stable, very low interest rates. As we all know, the CBR, or the central bank rate, has been maintained, but that same too is true of the treasury interest rates on treasury bills and bonds. So when you look at those three major indicators, interest rates, exchange rate, and inflation, the impression one would get is that the economy would be growing extremely fast because they are all in positive territory. But when you really go to the economy, you start seeing maybe that's not necessarily true in terms of GDP growth rate. It appears we are coming from, if you look on a quarter-to-quarter basis, last year, first quarter, we were at 5.3, we are down to 4.7, and we are coming from a high of 6.2. And the question then one wonders, microeconomic indicators and their trend is very supportive. Why is GDP showing signs of a decline? Why is the economy not firing as one would expect in an environment of low interest rates, in an environment of stable exchange rates, and in an environment where inflation is not a major issue? So then we wonder what is causing this decline. And if you look at the projections of the World Bank and IMF, they're suggesting 5.3 from a high of 5.9 last year. So truly the reality. But the first quarter suggests maybe it will still even be a struggle to get 5.5, if that is anything to go by. But then we go beyond and ask ourselves the big question that and the excuse we have used in the past. It is an election year. But when you look at the NSC, it's fairly telling that we haven't had a situation. If you look from May all the way from March, we have been on upward trend. The index moving all the way from 120 to nearly 165. So one can't say it was the elections, because the NSC is the biggest indicator of whether the market has received a viva. This will be leader measure. So it appears that from that perspective, and I see that seems not to be really, and we can see after the elections, the shaded section, it's even accelerating, even with profit taking, the index seems to be fairly stable and going up. So one discounts the impact of electioning as driving the low GDP growth rate. When you look even deeper in the exchange rate, again, you don't see, because for the last 1 year, we have oscillated between 103 and 104, or just basically, or the last 3 months that would have indicated whether there were signs. So again, it appears the post-election scenario. When you look at beyond the numbers, because numbers are very, very critical, you still see that post-election, the outlook suggests that flows of foreign direct investments have remained resilient and constant. So the flow, the next slide, Alex, suggests that there is no impairment in momentum of the economy. And looking at one of the data yesterday, 13 new hotels are being put in town with a bed capacity of 2,400. You look during the election week, Masai Mara, you couldn't get booking. So then you start wondering, this looks, the tourism flows themselves have remained very, very strong. So one can say that the GDP has been depressed by the election. Diaspora remittances over the last 2 months have gone up by 4 percentage points. And basically, it appears the Kenya's blood in terms of political risks have been significantly changed by the international observers who felt that the country is now reaching a level that its institutions can have the capacity to do what is expected of them, and the avoidance of any skirmishes or a peaceful post-election environment. So again, one says, and so we are left with the question, what is causing our GDP to decline, growth rate to decline? What is really driving that slowdown on the economy? And want to suggest that the real big elephant in the economy is the banking industry. It's the only thing that can explain the slack growth is the banking industry. And that leads us then to really put the thesis ahead that the banking industry is going through a very challenging environment. And when we look at it, yes, a lot has been said about the interest rate capping, but we feel that the interest rate capping has had a significant, not impact on the economy, not because of fixing of interest rates, but because of how it is done. And that is very well explained. When you look at the CBR rate is at 10, interest rate, hence capped at 14, depositors get 7%. So you're talking about net interest margin will be expected will be about 7%. But it's when you compare a 5-year bond attracting 12.5 vis-a-vis effective yield of the banks are below 11%. When you look at, and we'll go through the data, the composite yield for the loan book of Equity Bank is 11.7. When your loan is yielding 11.7 and an equivalent period board is yielding 12.5, then you start seeing the problem with the capping. Why? Because the 11.7 yield on loans has what one would call the credit risk factor, or the cost of risk. And equity's cost of risk is 1.4. So if you remove 1.4 from 11.7, Rohit, you are the last one in school. 10.3. So the yield on loans is 10.3 after netting off the risk, and yet you can get 12.5, and that really is where we believe the problem is. And until this problem is understood, now the problem have moved from the banking industry to the economy. It's the economy that really is showing really. But also, it is good not to assume all the problems of the banking industry have everything to do with the interest capping. There is also the question of what happened prior to interest capping. We had the adoption of very stringent CBK supervision, focusing on IT systems and loan book. And of course, that has really had implication. And of course, the central bank's action of putting 3 commercial banks under statutory management, which brought in uncertainty with adverse effect on interbank. And we'll see the problem that is there in the interbank, and we'll also see the adverse effect of public confidence, where resource redistribution has taken place among the banks. And an even bigger problem is the implementation of IFRS 9, which becomes operational 2018, requiring very significant change in provisioning policies and asset mix. So when you look at all those factors came into play at the same time. And one would really say the banking industry has faced a perfect storm, driven by those A, B, C, D, E factors. So they're coming into force at the same time of those forces have really driven. And if you look at the impact in the banking industry, which we'll then see, we'll see earnings. Look at earnings. For the first year on year, the top banks have had their earnings drop by 6%, and the small banks have had their earnings drop by 43%. And of course, that has reoriented the market, where you have 10 banks making 92% of all the profits, and 33 banks are left with only 8% of the market profit. And when 8% of the market profit is being shared by 43 banks, then you can see how thin. And the question is whether there is an economic return in those banks. And if there is no economic return, the question is whether there is sustainability, because the motivation for returns or investment is taken away. And that size and scale of a challenge is pretty big. If you go to the mechanism of interbank, again, you can see it is impaired. Alex, yes. You can see since October 2015, we have 3 different interest rates. Interest rates for banks that are perceived to be high risk, interest rates for banks that are perceived to be strong in the market. And as a result, the two seems never to be interlocked. There is a difference of nearly 600 basis points between what different banks pay. in the banking industry. It's a very unique, as you can see, it's for the first time we are having that phenomenon in the banking industry in a long time, aversion of risk between the banks. And that aversion then means that liquidity is not flowing within the market. As a result, the central bank has been left to address that problem through reverse repo and then redistribute liquidity. And we can see that in the next slide, where you see the volume of distribution. Yes, it's coming down, the amount, but we are still talking of very significant amounts of money. We are talking about 100 billion shillings within 3 months. Yes, it's coming down, but where is that money that is replacing this reallocation by central bank? This money we want to put is coming from loans. Banks are withholding loans so as to address their liquidity ratios. Why? Because they can't get money from the interbank market. If you can't get money in the interbank market and you want to move out of the central bank window, what you either do is you increase deposit or you lower your loans. Unfortunately, it has been pretty challenging. The market, because it's competing, the banks are competing now with the central bank for deposits. We have a situation where the balance sheet of the banking industry has stagnated. Deposits are really not growing. So this replacement of central bank redistribution is mirrored by a reduction in loans. And that then gives us the next slide, as we can see. And this is what then we think is the biggest problem with the GDP growth rate, that we are coming from a near high 20% private sector credit growth rate to 2% in May, and I believe almost 0 as we speak. So if really the private sector is not being funded by the banking industry. The banking industry, what it does intermediation. It moves from money from those who have excess to those who have deficits, or those who have resources and those who have ideas. It's the meeting place of investable ideas and capital, and the mechanism seems not to be working. I think central bank is on record that for a healthy GDP growth rate, we need a growth rate of between 12 and 15%. So we are saying what would sustain the GDP growth rate of Kenya of 6.1 is something about 15% GDP growth rate. And so we see when you are growing at 2% or at 0, what you are really doing is to take away fuel or energy from growth rate. And the economy then seems to be where it is. And that is the ultimate, the big impact of interest capping. It's not just a reduction in available credit to the private sector, but the private sector then investment in the economy has taken energy from growth rate. But where is this money? If the money is not going to the private sector and the banks have no liquidity, where is the money going? And we saw what it meant. We said the net yield on loans after netting off risk for Equity Bank is 10.3. Yet we can get 12%. As you can see, as soon as the law was mooted, Equity Bank's strategy changed, and significant amount of money went into the government treasury boards. And if you look at on the second paragraph, we were doing this solely on our own. Everybody thought it was a long strategy. But look at the second quarter. When equity treasury boards are growing at 2%, the banking industry, excluding equity, is growing at 28%. So everybody has now adopted the strategy of moving away from a return of 10% to a return of 12%. You place your money or you place your bets where the probability of winning is highest. And so the probability is high with a yield of 12.5% as compared to a yield of 10.3. And that reallocation of resources is what is stifling the economy. All the money is now being parked by the banks with the government. And so the 5% GDPs we are seeing then is government spending the same money on infrastructure, but it's not GDP growth of the private sector. It's public sector investment that is carrying our economy. Now, the question is if the rest of the banking industry is growing its holding of government stock at 28%, you just need to do this for 2 consecutive quarters, and then lending will be negative 5%. Just do it for 2 quarters, and growth in private sector lending will be down by about 5%. And then GDP, even the World Bank will be then long in their projections because it will be difficult even to do a growth rate of 4%. In simple, and numbers never lie. And we should really be honest as Kenyans when we really discuss issues that really is affecting the economy. If we then ask ourselves, what is the impact? Now, again, equity has been significantly rewarded because equity invested early. And you can see the upper curve represents the yield on the investments equity made. Now the banks that are rushing to invest in government bonds, the yield curve is the lower curve. And you can see it's a fairly significant differential of about 50 basis points. And for our Treasury Department, that then means a very significant premium that we could be able to resell our bonds at. So that's what you talk, that represents a premium or a capital gain on the whole 115 billion shillings of bonds that equity holds. And so if you look at the balance sheet, you see positive unrealized gains once you reprice these. And if we went to the market to sell, then we could quickly realize that gain. And that is a very significant 50 basis point spreading across 115 billion shillings of government bonds is very, very, very significant in what one would call unrealized gain. The industry is experiencing very, very turbulent headwinds. And we have seen the headwinds that are there, brought about by capping, brought about by uncertainty. There is no loan growth. Regional diversification, because there is no interest capping in Tanzania, there is no interest capping in Rwanda, Uganda, DRC. There is nothing like uncertainty in those markets. There is no inversion. The interbank markets are operating perfectly in those markets. So we have said, yes, we could make the region to be a significant contributor. The second thing is uncertainty and public confidence issues needs to be addressed by agility and very strong liquidity, and we'll see how that. And then, of course, if 115 billion shillings or 27% of the total assets are placed in treasury, then you need to look at treasury operations and see how efficient they could ever be made because any change there, as we have seen, we are earning 50 basis points premium above the rest of the banking industry. But you can see the impact that would mean. The yield a lot could mean a lot. So treasury operations becomes a focal. Asset quality, because of IFRS 9, asset quality becomes a center focus. And innovation and digitization then deals with efficiencies and of course, efficiencies leads to cost optimization. So that is the new business model that Equity has not only developed, but adopted, deployed, and is now monitoring. And we can see that we have now reached a threshold of sustainable operations. And looking at area number 1, non-funded, we can see funded income or interest income has come down by 15%, despite the substantial increase in treasury bills, interest income, the gross. Credit alone has come down by 36%. But when you undermine that with the contribution of treasury, the net loss in interest income is 15%. But we can see non-funded income, although of a lower base, have grown faster than that reduction at 20%. And we shall see the ratio between interest income has gone all the way, such that the mix is now 42-58, all the way down from 35-65. We are now at 42. The biggest driver of non-funded income, as we have seen, is transaction, salary, remittance processing, mobile bank commission, merchant commission, trade finance, suggesting this is sustainable other incomes. As the transaction grow, that will continue to grow. So it's not a once-off income. It's not a line that we have to say 20%, what is it? It's made up of all these fees and transactions, so it is sustainable, and we expect to. Then diversification, a little bit of looking at others like non-funded, and we look at merchant banking. As you can see, we are now just half year processed 26 billion shillings of merchant banking. Again, you can see the growth, 17% in volume with a corresponding 13% income in commission. Huge processing of transactions, and at the same time, money transfer, again, we shall see. Number 2 is regional focus, regional diversification and focus. And we see the region has grown its profit contribution by 69%, and total contribution of the subsidiaries moving from 5% to total 10% of the total profit of the group. And that now starts becoming significant. When you move from, in 1 year, from 5% contribution to 10% of the contribution. And we can see these, because these are 5-year-old subsidiaries. They've just broken even. We can sustain this growth rate, and we project in the next 5 years, the subsidiaries should be able to contribute 40% of the profit of the group within a period of 5 years. And that will then mitigate the challenge of interest capping if it is sustained in Kenya. And we can see the contribution of each subsidiary, as we can see in terms of growth, whether it is in deposits. As you can see, they are growing faster than Kenya, so Kenya is becoming smaller. Whether it's the loan book, Kenya has come down from 83% contribution to 78%. And as we have seen, profit, Kenya has come down by another 6%. So, and we can go through any of these areas, whether it's total assets, Alex next slide, or whether it is the profitability. We can see Kenya coming from 95% to 90%, and the same with loan book. So essentially, we are making pretty good progress and the most interesting is seeing the growth rate in those subsidiaries. These again demonstrates the momentum. If you look at the subsidiary like Rwanda, growing its loan book by 49% and growing its deposit base by 43%, DRC 26, 33, and as you can see, Uganda 17, 20. So when you compare that with Kenya, then you can see how the diversification strategy is likely to play out, because the subsidiaries have huge headroom for growth because they are young, and the market really has greater opportunity than Kenya. And if you look then the distribution again in terms of profitability, the momentum is pretty high, whether it's Uganda 139, Rwanda 75, Tanzania 55, huge momentum. And that's why we are confident that in 5 years, these subsidiaries would move from contributing 10% of the group profit to about 40%. Because of that momentum, they have the third one we said is really looking at agility of the balance sheet and saying during turbulent times, during eras where a possibility of systemic risk, it's almost obvious, then what you need to do is to have a very agile and a very liquid balance sheet. And those who know the history of equity, we maximize the profit at a liquidity of 26%. And as you can see, we have traded off profitability with stability. And now we are operating at 54%. And that again is confirmed by continuous real growth. And if you look at the balance sheet in terms of deposit, the liability side continues to be fairly significant. But when you look at the growth of deposits and the growth of shareholders' funds, the corresponding growth on the asset side is the 58% growth in government securities and 30% growth in cash and cash equivalent, suggesting that the bank can respond quickly and is adaptable and flexible and agile to any situation that can arise in the market. And we are very well positioned to exploit any opportunity that. And if you look at a deep dive on the loans and deposits, you see interest-bearing deposits are only 30%. So the 70% rule on interest earning only applies on 30% of our funding. The non-interest earning remains at nearly 70. When you look at the loan structure, because of IFRS, as you can see, we're moving away from unsecured, because unsecured FIS suggests you use the historical number data, and our NPLs on micros and small has been at 12%, so you need to make general provisions in advance of about 12%. So again, that cannot be sustained by a margin of 7%. So again, you can see how quickly we have been able, and maybe those who have read the Moody's report, this is what made Moody give us the highest rating they has ever given any bank in Kenya, simply because of our ability and flexibility and agility. And if you look at currency, look at the mix of currency, again, 26% of our loans are in foreign currency, and so they are cushioned from the interest capping. 30% of us, 26% of our loans are not affected by the interest capping, simply because they had been moved from local currency to foreign currency, where interest capping law doesn't apply. So again, that has helped us to be very, very well positioned, and we can operate there with market margins as opposed to legal margins. That's really a very central issue. And lastly, it's looking at Equity Bank Kenya, where the law is, and that tells you that the balance sheet agility is principally being driven by the Kenyan balance sheet. As you can see, it's where the government securities have grown by 68%. It's where cash and cash equivalent has grown by 14%. It's where the structure has had shareholders significantly increase their position so as to ensure that the funding is long-term. borrowed funds also 13%. And if you look, the balance sheet eventually we'll see is growing at 14%, the same rate. Why? Because we needed to lengthen the maturity of our funding because of any anticipated shocks. And again, in strengthening our liquidity, we have really focused on the bank being a liability-driven bank, not an asset-driven bank, because the asset side is where there are huge challenges, there are huge storms, and basically, if you look, we are growing at least 2 times faster than the banking industry in terms of deposit mobilization. That speaks a lot about the public confidence that equity enjoys, the power of the brand. When the banking industry has stagnated, as we can see, the bank deposit base is still growing at least 2 times. Whether it is from last year, as you can see, all the way from Q2 of 2016, the banking industry growing by 1%, Kenya is growing at, equity is growing at 10, Q3, banking industry is growing at 3, equity 22%, Q4. But this quarter, you can see the growth rate has been a little bit slower, and we all know it's because banks are competing with the treasury boards, because the maximum we can offer in terms of deposits is between 7 and 8%. But those deposits, if invested with the government, can attract up to 12%. So essentially, the crowding out of the banking industry by the government is very visible in terms of the growth of balance sheet. But we are happy that at this challenging time, when the public seems, our market share is consistently quarter after quarter growing and outperforming the banking industry. In terms of treasury operations, as we said, an area of focus, we have seen government securities have increased all the way to 116 billion. And we're saying with that type, then we need to really have very significant efficiencies. And as we can see, government income from government securities, while the securities themselves have grown by 58%, the return has grown by 116%, demonstrating the efficiency. And this reflects the yields. The yields have moved from approximately 9% to about 12%. That's why efficient operations really can give very significant change. And we can see the total income grows even higher at 74%, while the portfolio has grown only by 58%. That is the efficiency, and I want to applaud our Treasury Department, James Mutuko and his team, for really an excellent job of sweating our assets and ensuring that the operations are as efficient as they could be. And we have seen the yields moving from 10% to 11%. So when you increase the yields on a portfolio of 116 billion by 1,500 basis points, or from 1.5%, then the effect can be fairly significant in terms of that. The fifth area of the new business model that we have adopted is asset quality. And as again, we can see we've been very, very consistent, focusing on the loan book, ensuring the loan book remains as strong as it could be, given the challenging environment. And as we shall see, and that it is properly covered with provisions. If you look, the large enterprises is where we have had, and SMEs, it's where we have seen the largest strain, but these are fully secured. But despite that security, as you can see, we have maintained the same cover, despite the existence of securities. So quality has become very central. We'll be very conservative in terms of provisioning to ensure that we have enough strength to override any challenges. And if you look at individual NPL segment, I think one slide back, Alex, each segment, I want to also applaud our team in the bank for doing a great job. Whether it's agriculture, whether it's SME, whether it's consumer, almost all of us are operating within the 7% range. And the area that the bank found it increasingly difficult to make it is in the micro. And that explains why we have almost a 30% decline in the micro, because you can't lead a net margin of 7 when your loss ratio in terms of NPL is 13%. It's not possible. And that's why that area, then because you are not pricing that risk. And that is where IFRS will be a problem. You are not pricing the risk, but for micro, we'll be expected to put provisions of the potential probable ratio at 13%. And that then shows how well we have outperformed the market. While the market is at 10% NPLs, we're still at 7%. And given equity as nearly 10% of the loan book of the banking industry, it means that if you remove equity from the industry, that figure can go as high as 11, 12% because of our 10% contribution. The other area that we have really focused on the new business model is all about innovations and digitization. And the biggest is innovations, and we can see the impact of innovation. Look at it, we started just a year and a half ago with PayPal contributing 11% of remittances from diaspora, but it's now 40%. We've just launched another revolutionary product we are calling Wave, which is not even visible, but maybe will be visible for the next quarter. But again, it's very disruptive, and it will be able to take maybe 50% of all remittances being brought from the diaspora. And that capability continues to endure. The old models, the old channels, they seem to be challenged. And if they're challenged, then you have to meet the market expectations through innovation. So PayPal seems at the moment to be our winning horse, but it appears it is threatened by the next wave of innovation. And I want to really, under Patrice, commend the diaspora team for those innovations. And we can't wait to see the results of December, when, as you said, Wave will be the biggest contributor to diaspora remittances. I think this next team that has done very, very well is our EGHL team. Again, another great innovation. We see a money transfer, and it's not just a money transfer. We have now seen e-commerce. They have also joined. So they have nearly 25% of all money transfer, but they also have 30% of e-commerce payments through EasyPay. So when you really combine these these innovations, it's creating non-banking, non-traditional banking streams of income. And essentially, we believe this is where the war will be won or lost. And as we have said, then equity remains fairly stable. Taking 25% of the market share of money transfer with a dominant telecom industry, then, or from a dominant telecom industry, for us is a huge achievement. Taking 30% of e-commerce, retail commerce payment, again from dominant telecoms and internet platforms, we also feel we have really made significant. And if we move to the next slide, the big innovations came in July, then with EasyPay, with EasyBiz, with EasyNet, and EasyApp. And those who may not have got these products, we just want to show you how fast these products are moving. And this, we believe, is the next transformation. This is adoption of cash and liquidity management system by corporates. And you can see the volumes they are processing on monthly, 11 billion shillings from zero in last year. As you can see, we started in August, and if you look at transactions, again you see huge level of transaction. If you look at EGHL, which, as we have said, is processing 30% of all national e-commerce, again you could see how big that is. If you look at EGHL app, again, how much is being downloaded and being adopted again, and we believe those are innovations. And the market then recognizes as the leader, whether in innovation, in mobile banking, in telecom banking. And then the last area that we have really focused is on becoming an efficient bank. And we can see what we are doing, digitization, the impact it has on staff costs, digitization is having on other costs, and as a result, our cost-income ratio, despite the rapid growth in the subsidiaries, as we saw Uganda growing by more than 100%, our cost-income ratio is not reflecting that growth. So revenue is disproportionately growing faster than costs, and we have been able to maintain a flat cost-income ratio, cost of funds, cost of deposits, because of the mix, as we saw, 70-60 of interest earning and non-interest earning, and the mix between deposit and term loans. Again, you can see the play between deposits, that loans have only increased marginally from deposits. So there isn't much impact. And as we said earlier on, we said net interest, the yield on interest earning assets are 11, while we saw treasury bills are 12, and yet there is cost of risk here. And again, we can see the net interest margins have already stabilized, and we don't expect any. And we can see the efficiencies also by adoption of variable cost as opposed to fixed cost. ATMs and branches continue to have their contribution declining significantly, and its self-service platforms of EGHL that has really taken off, while complemented by third-party infrastructure of merchant banking and agency banking. And again, that has no fixed cost to us, and that explains why the cost-income ratio. And if you look at the agents, how fast they are growing, both in transactions and volume they are playing, then you can really see 90% of all the transactions now are outside the bank. They are on third-party agents, they are on variable cost, and that explains why staff costs are growing down the way we. And if you look at EGHL and digital banking again, you can see how fast they are growing. Look at how small branches are only processing 13% of the loans. 87% of all the loans, the other loans are being processed on the digital platform. You apply on your phone, and the loan is disbursed, and you use EasyPay, you use Easy App to move your money. I think it's good sometimes to be very confident of what you are doing, but it really becomes great when industry experts validate your business model. And we've really been honored that the market, the professionals in the banking industry, and sort of all having a consensus. And we'll take you 3 or 4 validations. The first one is by Moody's. I think we know there are 3 major international rating agents, and we're privileged this quarter to have been rated by Moody's. And as we can see, equity has been given the same rating as the country's sovereign rating, global rating of B1 with a stable outlook. And that really then answers to the confidence that we are enjoying. When a company is given the same rating as the sovereign rating, then it tells you how strong maybe that will be. And the second thing is we have been given the highest credit rating within Kenya, national scale, of AA1. Again, we are the bank now holding the highest rating ever granted by Moody in Kenya. And the reason Moody gave a strong brand recognition, which we saw, that allows the bank to grow faster than the industry, solid liquidity buffers, really answering to the strategy that we have established domestic franchise, really populated by agents and merchants, and extensive adoption of digital and alternative distribution channels. That's really bringing the future to the present. And so for us, this validation, and particularly for investors, at a time of banking industry challenge, then speaks volumes. And then ranking, this is more of ranking, validation through ranking. As we said, and it's important we all remember how excited we were in 2014 when Equity joined the ranks of the top 1,000 largest banks in the world at number 999. We just made it. But you can see 4 years later, we have 200 banks behind us. We are now number 806 largest bank in the world. Size is good, but quality is really sanity. And if you look at it, we moved from being ranked the 112th most solid bank. We are now number 37 most solid bank. And so this issue of agility, this issue of having a very well-prepared balance sheet, again speaks to that. And as we can see, return on assets, the impact of interest capping, we have been pushed back from number 4, number 8 to number 11 and 45. But as we said, the new business model will be able to hopefully push us back. And if you look at the global credit rating, they have retained as long-term and short-term with a stable outlook. So essentially, that validation. And then relativity. Sometimes it's not who you are, it's who you are relative to others. And this we still continue to celebrate, that out of the 24 entries that we made in the banking industry, we carried awards in 19 of those entries, with 15 of them being number 1. And we did take a lot of pride. We're so proud that Euro Money, for those who really like Oscar, particularly this is our Oscar in the banking industry. And I see it being rated the best bank in Africa, the best bank in SME in Africa, and the best bank in Kenya. It gives us a huge pride. And also being ranked the best super brand, or the banking super brand for East Africa for 10 consecutive years is huge validation. And for the banker, again, being rated the best retail bank in Africa, the best retail bank in East Africa and Kenya, again, validates the business model and the strategy of Equity for those who have a long-term view. That brings me now to focus on the numbers, the intermediation, because this is what investors, they said, James, yes, the story sounds good, but what do the numbers say? And the numbers say big things. The first one is that they say Equity has grown over the last 1 year by 14%, when I guess the banking industry is growing at 3%, to surpass $500 billion shillings. The last time we were with you, we said we are near have a trillion, almost have a trillion. We are now above half a trillion. And a balance sheet of half a trillion in a country whose budget is 2 trillion, it tells you how big the balance sheet is, and we're really proud about that balance sheet. But it's the confidence in customers where their funds are growing by 13% at a time when deposit in the banking industry has flattened. That gives us huge confidence about what the public thinks about us. And that's what Moody is calling the franchise, the brand that Equity has really built. And so that's how we are looking. Balance sheet in just simple really growth of 14%. As we said, the region growing faster than Kenya, and we are very, very excited about that. And when all that is done in terms of profitability, we see the bank withering the huge challenge of interest income capping, where we lost 36% of our loan interest income, mitigated that significantly with the treasury bill income, reducing that to only a negative of 12%, and with net interest income down 15%, but mitigating that with non-funded income, which grew by 20%. And so total income, despite losing 36% of all the diversification from interest income to non-funded, as you can see, the net loss is only 4%, and it's heavily mitigated by reduction in operating cost, which has come down by 1%, and as a result, the bank registers profit before tax of 13.3 billion shillings and 9.4 billion shillings profit after tax, again confirming the sustainability of the business model. During turbulent movements, very challenging environment, but because of the business model's resilience, we are able to get fairly significant returns. And that gives the shareholders, I guess, the highest return on equity. We are, again, very, very happy that we have outperformed the banking industry to give our shareholders a return of 22.3%, which is still far above our cost of capital. So again, that's, I guess, would satisfy. And yet, it's the best in the banking industry in Kenya, with a return on asset of 3.8%, and with very healthy ratios. Whether you look at, as we said, net interest margins, whether it is non-funded to total income, all these ratios are available to you. And we have also given, but the most important thing maybe to note is the capital ratios. The capital ratios for the group are far, far above the statutory requirement. So the headroom and the cushion to be able to ride the tide or the headwind is very, very, very significant. We have given you data on the outlook, and that again, just to highlight, loan growth, we had anticipated 0 to 5. The actual is we are -1. So deposit growth, we had anticipated 25. We said we are now competing with the Treasury, who are able to give 50% more than we are able to give. They're able to give 12% when we can only give 8. And that is really where we're straining there, but we are optimistic. Things will look better. Net interest margin almost there. Cost-to-income ratio almost where we had projected. Return on equity, spot on. Return on asset, spot on. Cost of risk almost there. NPLs close to where we had targeted. And we say we are fully committed to this forecast. And we're working very hard to deliver on that forecast. As you can see, the regional contribution, we are ahead of that. assets. We are making good progress, and we are also very confident. There is always people who ask, finally, the returns broken by individual or subsidiary, they are there. The ratios of individual subsidiaries at the upper deck, so you have all the returns that you may want to give. And that really brings us to the end of today's presentation, but we'll seek maybe your indulgence, but we thought we needed to explain to you beyond the numbers, the environment, the change of business model, the differentiation that equity has made. And I want to invite Brent for a minute, maybe to speak to the issue of equity's differentiation. How well have we differentiated? As I also invite Mary to talk about execution of the new strategy, just to ensure that...
Good morning, everyone, and thank you for participating in our investor presentation. I think what's key to highlight in the numbers, which doesn't necessarily come out when you look at the numbers, is the decisiveness and the consistent story that Equity Bank management has been telling. So when these challenges appeared last year, there was a lot of questions around how will banks react. And we came out with a very decisive response to that. And these numbers that you see and the trends and the ratios you see are just a validation of that execution of what we've been telling investors. So what this tells you, more importantly, in an environment like this is quality of management. And I think that's very important to highlight in these numbers, is decisiveness and consistency in management. I think that's very important to highlight. And you can see it in the numbers in terms of the trends from when we've been telling this story. So it's not just a story. I mean, it's a story of numbers which highlights this execution. So I think that's a key thing to highlight that I just wanted to bring out, James. But otherwise, I think you've captured the business model, how we've evolved, not necessarily just because of the interest rate capping, but the innovation and the adoption of new technology was something that was already adopted many years back. And so we were just well positioned in the challenging environment of 2016 and 2017. So the important point is just the quality of management. Thanks, James.
Thank you very much. So unfortunately, we have never been able to push that on the balance sheet, the quality of management. I'm really proud to have the team I have, because once we make decisions, we do a lot of research, we do a lot of sensitivity analysis, and eventually once we decide to execute, there's only one thing: execution. And I'm really glad that we are getting. Mary, anything on the strategy that really we needed to add, please, so that you preempt all the questions? I'm trying to preempt all the questions by providing the answers that we all know are likely.
Thank you, James. Good morning. Definitely a very, very difficult environment to operate in. And I don't think it's just for banks. I think it's all the sectors are one way or another affected. But I can say that for equity, we have had a specific focus. And I can say that we did not start the planning because we've done a lot of scenario planning. We did not start last year when it was very clear that the operating environment is going to be very, very difficult. Fortunately, we had started our planning much earlier. I would say probably around the 2010. That's when we developed, for instance, the mobile innovation strategy, which we then pushed with a lot of speed and a lot of focus. So by the time things were really getting tough, you can say that the building blocks had already been laid. You will also remember that around 2008, we had already started the regional diversification strategy with the entry to Uganda first, and then South Sudan, and then all the other countries, Rwanda, Tanzania, and then finally DRC about 2 years ago. So what I would say is that we had the plans in place. The only thing we have done now is really fast track those plans. Fast track the innovations, and we are very, very lucky. I can say that we have the best team we can have to help us through the innovation. We did the customer segmentation. That was also around 2014, 2015, just to identify the segments of the customers that we want to focus on, and then identify the channels that each of those customer segments is likely to like to use or to love to use based on what they are doing. We segmented the business all the way, and that is also helping us so much. And then, of course, we are looking at what are the other value creation areas that we need to look at. What are these customers? They started at the intermediation stage, but we are also looking, in addition to the savings and the loan, what are the products, what are the services do they consume? And we looked at the whole lifestyle of the customers at the different segments, and we were able to figure out what is it they are going to consume in each and every stage of their life, whether you are a student, or when you get your first job, or when you get married, when your kids go to college, or whatever happens in your life. You start a business, various stages of a business. So you can see it's a very, very comprehensive model, and we keep on just looking at it in a very dynamic way, trying to understand also how the environment is moving, how the customers are changing. If, for instance, you look at the customer base 10 years ago, it's very, very different. The composition, even in terms of the age of the customer, we have moved significantly to the younger customer. How does that customer want delivery? So those are the questions that we keep on asking ourselves. And I can also say that one of the things that has helped us as Equity is our agility to change. Our agility to change to meet the changing and dynamic environment and the customer tastes and all that and the requirements. That is probably one of the biggest strengths that Equity has. I think what we can say is that in accordance with our critical success factor number 7, we will continue to do whatever needs to be done to deliver absolute value or the best value to our stakeholders. We say that we optimize or maximize value to our stakeholders, especially the investors. And we are going to continue to do that to the best of our ability, however difficult the environment will be. So thank you very much for listening to me. On the regional, sorry, just one thing. On the regional subsidiaries, we have seen the growth phase, you know, the very high investment phase pass. And I think James alluded to that. Now you are seeing a more high growth phase, whereby, and also we are seeing a rollout of the innovations to the subsidiaries. I know like Easy and all those other innovative EasyBiz and all that, they are being rolled out to various subsidiaries, Uganda, Rwanda, Tanzania, and they are at different stages of development and rollout to the customer base. So as we go along, you will continue to see them contributing more, not just to the balance sheet, but also to the profitability of the whole group in total. So we are very, very optimistic. Obviously, apart from South Sudan, where we know we still have a problem, all the others are doing very well, and we are very proud of the leadership in those jurisdictions. Thank you very much.
Thank you, Mary. I think, Lily, the issue is these numbers are a product of a strategy. And this is a strategy that has been adopted in the last 3 years, accelerated with the capping of interest rates. So you have just seen us maybe scratching the surface. So better things are yet to come as the benefits of the strategies, the economies of scale, and perfection on execution is achieved. Many than Ade's fears, I have been asked before, James, capital, do you require capital because of these subsidiaries? All our subsidiaries now can sustain their growth from internally generated funds. So we no longer need to invest in any of these subsidiaries. So those subsidiaries are now able to fund it from internally generated funds, very profitable. And again, the next thing is they can grow faster than Kenya because all the products that we have tested here, we be rolling them. As I prepare, Jack, I can see you there. I want you to talk a little bit specifically about the innovations, whether it's that the payment space, the Huduma, the e-citizen, the e-commerce, and maybe also importantly, whether there is a teaser that is yet to come, and where we are with the app. Jack is our managing director of FinServe, the innovation hub, which also owns Equitel.
Thank you, James. Good morning, all. So we have started developing, or we're in the final stages of rolling out all our digital strategies throughout all the subsidiaries. Some of them are already on pilot, and within the next 1 week should be in full production throughout the region. Even having said that, we are building what you'd call a virtual model for banking. So, we are now expecting customers who are getting interest in our services from Ethiopia and as far flung as Angola, for our e-commerce platforms, etc. So you see the diversification that James had mentioned earlier on banking is what we're now trying to, get pushed through to the market. Having said that, James mentioned a teaser of a certain application that we are rolling out into the market. Now I won't let you in on the secret just yet.
But you can let us know where we are now with the app, the old app, and what functionalities and capabilities.
Yeah, James likes pushing me on it, but I won't show you too much about it because I'd like you to experience it. But the existing application has new functionalities, including PesaLink that is already commonplace. We have converged M-Visa and MasterPass into one application, so you don't have to have multiple applications to do retail payments. And we're also integrating to the NFC capabilities of your handsets. So, all those digital type experiences, you'll have it on one single app. The other thing to note is that the Easy app is one app for all countries. So we're not releasing multiple, distributions. It's just one app. You go to Tanzania, it switches your profile to Tanzania. You go to Rwanda, it switches your profile to Rwanda. So that is the kind of application we are building. I think it's actually probably the first in this market, where it's multi-country sort of application, all built on the native, leveraging off the SIM card itself. Yeah.
So what it means is banking without boundaries. You can imagine how dynamic that app is. It converts itself to the country you are in and starts serving you in Tanzanian shillings when you are in Tanzania, and Rwanda francs when you are in Rwanda. You don't need to make any changes. So this is really huge innovation. I know people have been asking about what will be the impact of IFRS 9, Elizabeth and Heath. We're starting with Elizabeth, maybe quickly, and later anything else you may want to talk about, quality and the way you are managing and where you think the future of credit is.
Thank you, James. Good morning. Basically, this animal, IFRS 9, was introduced back in 2014, but will be effective 1st of January 2018. So as a bank, we have been simulating and evaluating the impact of this. But just to, before I get to the details, probably most of us are not familiar with IFRS 9, and it's an accounting standard that has been rewritten because we have been operating under IAS 39, International Accounting Standard IAS 39, but now IFRS 9 has been brought to being because it's much more forward-looking compared to IAS 39, which has been used for measuring the financial instrument or enabling us determine the impairment or provisions we take for the financial instruments we are holding. If I talk specifically in credit, the approach has been reporting or recognizing the provision based on what we would say incurred losses. But IFRS 9 is expected losses. Expected meaning you expected to predict the losses as you book the loan facility on day one. And that is what James was talking about. The moment you take a loan facility or you're about to book that loan facility, you have to predetermine the probability of default. And how do you determine the probability of default? Two things come into play. Number one is how similar facilities or the portfolio of similar nature has been performing. Number two is the specific transaction. You look at the specific transaction, the characteristic of that transaction, and you're able to do an internal rating and give it a prediction as to whether it is a good rating or a bad rating, maybe on a scale of maybe 1 to 3, and based on that, you expected to take a certain level of provisioning. The difference has been, previously we were not expected to do that. The other key material difference is that you're expected to also take care of anticipated scenarios emerging, like what James was demonstrating on the downside of the macroeconomic conditions. Currently, we are not expected to do that, meaning we'll have to have economists to be able to predict what is the impact of the emerging macroeconomic conditions, any shocks that are expected in the economy or any other area. So those are some of the changes that are expected to happen. Again, we were previously off balance sheet items. We were not carrying any provisioning or impairment, but now with the LCs and other non-funded facilities, contingent liabilities in our books, we expected to carry provisions for that. So those are the major changes, and we are still doing the assessment. But the good thing is, depending on the provisioning approach, if you have been conservative enough and you've been in compliance, then the impact may not be as much. But if you've not been doing that, then there has to be some impact. The impact is there. We are still carrying the simulations, and but we would say it's within our expectations, no shocks, and we shall be able to release more information as we come to the conclusion of it. Thank you.
Thank you, Elizabeth. I think Elizabeth has already explained the basic tenets of how IFRS 9 is going to work around. I think it's very important for us to realize that traditionally equity has run fairly conservative portfolios, both on the funded side as well as on the non-funded side around. So as we are going through the assessment process of the exact impact, which we will share later on as we finish our exercise, it's important for the investors to realize that traditionally we have run a very conservative book around. Now, even in terms of the portfolio going forward, in terms of how we want to go and book new assets going forward, the understanding of IFRS 9 in detail allows us to be able to pick and choose the right credits which we would like to go back and deploy our capital to. It's also very important, I think you have always heard severally from us in the past quarters around that we just don't look at credit as a business, it's the entire relationship with the customers. It has to be well-rounded in terms of the funding relationships, in terms of what sort of trade finance, in terms of what sort of payments, collections, cash liquidity management, and so on and so forth. So we try to look at all these relationships around with the customer. And I think the IFRS 9 movement around from IAS 39 allows us to be able to leverage that relationship, and you will start to see how we were prudently making those decisions up front all along the business. And I think IFRS 9 will kind of reward banks that actually goes and does a better relationship management approach in managing the customer relationship. So I think that is also very, very important for us to be noticing. Thank you.
So essentially what it means that there isn't much that we had not factored into our books that we would expect in terms of IFRS shock. So they are factored in the numbers that you have seen. Batesh, execution, anything, nothing? Anything, Obeshi, on numbers? We covered everything. That then, let me try and summarize what we have said about the numbers. The number of customers have now reached 11 9.7 million customers. And we are very optimistic that this year we'll celebrate with 12 million customers. Later, if you want to round it, you can round it to 12 million customers. Our subsidiaries are now all well capitalized, don't require any additional capital. FRIS 9 doesn't require any further capital from our own assessment, and that the bank from capital issues is fairly well funded. And from that balance sheet, again, we emphasize that the new model of Equity Bank is to play a lot of weight on efficiencies and cost maximization or optimization, cost optimization, not maximization. We've really looked at treasury functions and said they carry 27% of the balance sheet. They must be very efficient, and we are playing there. We are also really looking at and we'll see really the growth of numbers will be much faster because of digitization. But the numbers we are talking about, the releasing, the balance sheet of the bank has grown by 14% to surpass ½ trillion Kenya shillings, driven by a 13% growth in deposit base, while the banking industry has been growing at approximately between 3 and 5. So we are really outperforming the industry significantly. Profits have been generated, but has been affected by a decline in interest income, 15%. Net total income down 4%. But returning a profit before tax of 13 billion shillings, 13 billion shillings, and an after tax of 9.4 billion shillings. So those are the numbers that we are releasing, and maybe now, if Alex, we can put a mic on this table, I could facilitate a question and answer session. Let's give them one mic there so that I will just be pointing who is to answer the question.